Yes, good evening, everyone. All right, we are all welcome to tonight's class. All right, so yesterday we look at introduction to forex trading. We look at what is forex trading, why forex, buy versus sell, currency pairs, pips, and lots. All right. So if you've not watched that video, if you've not watched that lecture, listening to it, you should try and make sure you go through it. All right. Okay, so without wasting much time, let us go straight to today's class. All right, so let me just go straight to today's class. All right, so in today's class, we'll be covering two topics or two courses, sub-courses, right? So we'll be covering them very, very quickly. We try to be fast as much as possible. All right, so tonight we'll be starting with FXT102, which is Forex tools and the terminologies in Forex trading. All right, so let's check what are these subtopics we are having before us tonight. We'll be looking at broker. Who is a broker? We'll be looking at who is a broker. We'll be looking at what is a broker. We'll be looking at MetaTrader. We'll be looking at trading view before moving to the terminologies. All right. So these are the things that is very important. You don't want to miss. You want to understand them. All right. So firstly, broker. So a forex broker is a financial services. Okay, sorry. I think there's a little. All right. Okay, it's fine. A forex broker is a financial services company that provides traders access to platform for buying and selling foreign currencies. All right. Now, a broker is a financial intermediary that matches counterparties to a transaction without being a party to it. In Forex, a broker is an agent or a company that executes orders to buy or to sell currencies for their clients. They act as intermediaries between banks, bringing buyers and sellers together for a commission paid by the initiator or both parties. Brokers are like agents working on commission and not principals acting on their own account. All right. Okay, so in fact, without any further explanation, I think you should have the better understanding of what a broker is or who a broker is. All right, but let me just add to the explanation. All right. Now, when you are starting your forex trading journey, all right, you need a broker. A broker is your partner. It's like your partner. All right. Like the illustration I made yesterday, you working in a company and your manager is going to send you on, maybe an abroad course. Then you walk up to a bureau de change to buy you needed some dollars and then you buy the dollar by yourself and all of that. So in forex trading, you don't have to do all that, okay? So it is your broker who is your partner now that helps you to execute both buying and selling orders. All right. So there are a lot of brokers. You want to choose the best broker, right? Like our normal banks in Nigeria, we have First Bank, GT Bank, and all of them like that. They offer different services. And then I think they also have some unique services, all right? So in the same way, we have brokers that, offers different services. So a lot of them, have their own uniqueness, their unique services they offers and all of that. But there is a common service that they offers, which is to help you execute buying and selling of forex trading, right? Sorry, of currencies. All right. So they are like a link. They are a link between you and the financial market. Okay. So it is a broker that makes it possible for you to be in your house and then just pick up your phone, your mobile phone, or your laptop, and then place an order. and it will be made possible, right? It will be done. Okay, so that is the work of your broker. So now the brokers offers more services. All right, they offers more services. Now, another advantage of a broker or brokers is that you deposit your money into, like, with them. You deposit your money, like, with them. You your with your broker, you open a trading account. All right, you open a trading account. So that your trading account is, like, I think it is, let me just say, it is as good as your bank account. All right, so you fund your trading account that is you created with your broker. All right, so your broker help you to convert it to dollar, to the, like, the current dollar rate, that the current dollar rate when you made the deposit. All right, so, and your account will be credited in dollars. All right, your account will be credited in dollars. So I would like us to do something. Just try to just browse top 10 brokers in the whole world. All right, so top 10 brokers in the whole world. But I think my network is very poor here, so I don't want to want the phone to be freezing, or my device to be hanging and all of that. I don't want that, and I don't want us to waste a lot of time. So I think what I'm going to do is that after this class, I will just browse, like, top Forex brokers. I will just do a little video, like on that separately, or just do that and just link it with this. All right, so now if you search for the top 10 brokers in the whole world, I think yes, I checked this morning, and we check often, but usually it is like sometimes either you see Xness as the first, or the number one top broker in the whole world. All right, or you see AvaTrader or some other brokers. All right, but do you know the reason why we agree that Xness is the best? Because some of these, when you make some of these searches, you will realize that AvaTrader is top in some websites when you make the searches, and some other, if you search in some other websites, you see Xness. All right, so now the reason why we'll be picking Xness, and the reason why I'm using Xness. Okay, sorry, I have used Forex. Like, Forex is a broker. I have used Deriv. Deriv is also a broker, like previously known as Binary. All right, I am currently using Xness. All right, so, and it's because they are giving me the best. Okay, but currently it's either you choose between just go for Xness. Do you know the reason is that with Xness you will be able to deposit the minimum of $10. All right, whereas with AvaTrade, your minimum deposit is $100. Okay, the minimum deposit is $100. So what if you don't have up to $100? And then some of you in the class have asked me that what is the minimum amount that I recommend for as a trading capital, and I recommend $50. All right, so I recommend $50. So it means that if you have $50, you will not be able to use AvaTrade. But Xness is very perfect. That's why I put the Xness here. All right, so we already have idea of how broker works and all of that. So I will do a separate video how to create an account with Xness and all of that. It is very, very simple. All right, it is very, very simple. So let's move forward. So the next thing we'll be looking at is MetaTrader. All right, there's MetaTrader 4, there's MetaTrader 5. But in this case, we'll be talking of MetaTrader 4. Yeah, it is the same thing. It's just like MetaTrader 5 is like the new version of MetaTrader. All right. However, MetaTrader 5 did not come to replace MetaTrader 4, because MetaTrader 5, when you open MetaTrader 5, is exactly like this, but you will realize that with MetaTrader 5 you will be able to trade like assets like cryptocurrencies, like indices, securities, and some other stocks. All right, so now what is MetaTrader? MetaTrader is also known as MT4. So MT4 is an electronic trading platform widely used by online retail foreign exchange speculative traders. All right, it was developed by MetaCodes software and released in 2005. The software is licensed to foreign exchange brokers who provide the software to their client. All right, so now the difference between your broker and MetaTrader is that when you open a trading account with your broker will provide you a login details that you can use to log in like into or on a MetaTrader platform. All right, so that you'll be able to trade. You cannot trade where, although they are like as technology advances, you can trade directly with your broker, but it's not advisable. So your broker is not advanced to the level that they will provide for you every tools that you need, unlike MetaTrader. All right, so now MetaTrader is available on Windows devices, on tablet or iPad, on iOS, and on Android. All right, so it means that if you don't have computer, if you don't have laptop, if you have a smartphone, yeah, you can trade Forex. All right, so if you have the both, you can trade Forex. All right, so like I mentioned earlier, you don't need to open an account with MetaTrader. As you can see here, the software is licensed to foreign exchange brokers who provide the softwares to their clients. All right, so XNES will provide a login details for you that you use to log in, access this platform and enter trade. So that is MetaTrader. All right, so I don't know, maybe you want to ask a question already that can you trade Forex without a broker? It's not possible. You need a broker, all right? You need a broker. So it's a broker that takes your order and, make it very active and all of that. So now we'll be looking at trading view. Now, you see, this trading view looks like, let me just scroll up a little bit. You can see if you see these two screen or windows, this black one, like this dark theme, and also the light one, that's trading view, and it looks more like MetaTrader. It's not MetaTrader. All right, trading view is a social media network. It is a social media network. It is like an analysis platform and mobile app for traders and investors. The company was founded in 2001 and has offices in New York and in London. All right? So you don't enter trade like MetaTrader 4. You don't enter trade on trading view. All right? So you only use trading view for your analysis. Okay? You use trading views. There are a lot of tools made available. Let me just zoom out so you will see them. See the tools here, all of them, all these guys here. Let me use this team brush too. All right, so you see all of these guys here, okay? All of them, they are the tools that is available. However, on MetaTrader platform, you also have access to some of these tools, but trust me, TradingView gives you the best. All right, so you make your analysis with on TradingView platform. All right, so Yes, so when you make your analysis, you already know. Let's say you are analyzing Euro USD, so you already analyze, and then based on what you see, you just realize that okay, I think I'm okay with the analysis, and then at least the little analysis I've made, I am satisfied, and then I can boldly say that euro will be increasing in strength or in value, while dollar will be reducing in strength or in value. All right. So that is what you do on TradingView. Now, you see, it looks like there's a difference between the two windows here. That's the black one and the white one. There's no difference there. The only difference there is that you see all of this one, you are seeing something like like electric wire and all of that. No. So these are the tools that you use. All right, these are the tools. There's a lot of just that this white, this very one is like it's just like a plain chart. Yeah, it's just like a plain chart or a chart with a little, with a little one or two tools that you can use. But this one is very very complicated. So don't be distracted. Don't let that confuse you. All right. So that is TradingView. So I don't want to go much into that. Also, I don't want to go much into that because we are still going to make use of it in the future, lectures. So let us not waste much time on that. All right then. So the terminologies. So okay, sorry. Before we move to terminologies, let me just quickly show you something here. All right. You have already seen some of these things that we talked about yesterday. If you check this side, so let me move my camera to this side. If you check here, you see the prices, all right? So you see the prices here. You see the prices here. Can I move this thing? All right, you see the prices here. Let me just drop box. So all these are the prices. All right. So we talked about that yesterday. And what can I quickly show you before we move ahead? All right. Okay, I think we should just go ahead. There are some things here I want to talk about now. So my camera come back to your position. All right, so let's move to the terminologies. Now, the first terminology, the first term is currency pair. We talked about this one yesterday. All right, I believe we still remember very well. So let me just run through it again. In simple terms, currency pair are the two currencies that made up a currency exchange rate. All right. Like I said yesterday, that you don't know the value of a currency until you compare it with another currency. All right. So currency pair is what make up the, a currency exchange rate. All right. Now, a currency pair is typically listed as a number of base currency unit per one code. Unit per one code currency unit. All right. They are divided into three main categories. We have major pairs, we have cross pairs, and we have exotic pairs. All right. So what are the major pairs? Major pairs are the pairs of currency that are mostly or most commonly traded. All right. So, we have like a lot of currency pairs. In fact, I don't know, maybe if I should say like thousands of currency pairs or hundreds of currency pairs, but we have a lot of them. All right, we have a lot of them because you cannot use the number of like countries to actually know the numbers of like the currency pairs available. All right, because as you are pairing euro with USD, you are pairing euro with another currency, you are pairing euro with another one, you are pairing USD with another one. So that makes it very very plenty. All right. So, but there are some of these currency pairs that are, mostly traded or commonly traded, like something like Euro USD, USD JPY, USD JBP USD, and AUD USD. All right. So these currencies are like very, very commonly traded. That's why they call them major currencies. So, all right. And now cross pairs are currency pairs that do not include US dollar and most commonly include Euro JPP, NZD JPY, CHF JPY. All right, so it is very, very clear. So any currency pair that US dollar is not included, above here we're in major pairs where we have Euro USD and all of that. So, but major currency pairs are the currency pairs that US dollar is not included in them. All right. So now exotic pairs are currency pairs that involve less commonly traded currencies, such as Euro TRY, USD. This MXN is Mexico currency. So Canadian dollar, Japanese yen, USD, Nigerian naira. All right. So this is where our own currency pair falls. But in forex trading, you're not trading like USD and Nigerian naira. All right. Because okay, you already see it now that it is under exotic pairs, so it is like rarely traded. All right. And one thing you should know already is that these currencies pairs that are rarely traded or that are less commonly traded, they lack volatility. They are not as profitable as the major pairs and all of them. You understand? So that is how it is. Now maybe I will just show you when we get to the practical aspect of it. So I will just show you how USD Nigerian naira is, like the chart is, so you see yourself. All right, so let's move to the next terminology. Leverage. Now leverage, this is very, very important. You should know this. All right. So leverage is the use of borrowed capital to increase one's buying power in the forex market. All right. You can use leverage to trade large amount of currency that sorry, let me take that again. You can use leverage to trade larger amounts of currency than what you have in your trading account. All right. Okay, let me quickly explain this in a better way. You see, remember I was talking about lot yesterday. All right, we talk about standard lot, we talk about mini lot, we talk about micro lot. Standard lot is like 100,000 currency units. Mini lot is 10,000 currency unit, and micro lot is 1,000 units of your currency. All right. So, and micro lot is the smallest lot. All right. Micro lot is the smallest lot. Standard lot is 1. Let me just do that here. So standard lot is, let me bring my camera, come to this side. All right. So standard lot is 1. Micro or mini lot is 0.1. And micro lot is 0.01. All right. 0.01. And that is the smallest lot size available in forex trading. Right. So let me clear all this and come back. So now if you are trading the smallest lot size, which is 0.01, it means that you must have, and let's say you are trading Euro USD, it means that you must have at least $1,000. $1,000 is currently in Nigeria 1.4 million. So it means that forex trading will not be for everybody. Okay, forex trading will not be for everybody if it is like that. So now, what now make people like of low class or that do not really have much in the like with them, maybe you that have $100, you that even have $10 or $50 can actually participate in forex trading. Is leverage. You understand? So leverage actually gives you strength, more increase your buying power. You understand? So increase your buying power. So it means that you can actually trade more than your $100 account. All right? So you can actually trade more than your $100 account. So let's move forward. For example, if you trade if you have a trading account with a brokerage that offers 50:1 leverage, it means that you can trade up to the value of $50 for every $1 in your account. This way you can make larger trades than you could otherwise with just your own account. All right, so that is very, very simple. So it means that now, brokers, and that is one of the things that you want to look for when you are that you're actually looking out for when you are choosing your broker. Okay, so forex trade like XNext offers like very, very awesome and very, very awesome leverage. All right, so for instance, if your broker is like offering you 50:1 leverage, so it means that for every single $1 in your account, you can trade up to $50. That is using $1 from your account, from your capital. Your broker will help you, will enable you to trade forex, will enable you to trade in the forex market up to $50. All right. So we have some other, leverages ratios in the table below. Let's say like this column use margin. We have $100 from up to down. So now the leverage, there's 1:1 leverage. If your broker is telling you that, see, the maximum leverage we can give you. In fact, if your broker is telling you 1:1, it's not even giving you any leverage, because it means that it is still that same your $100 that you are still trading with. Okay, so if your broker is giving you, like offering you 10:1, it means that your with your $100 account, you can trade up to $1,000 worth of like in the forex trading market. All right. So if they offer you 20:1, it means that with your $100 account, you can trade up to 2,000 positions or $2,000 trade orders in forex trading market. And you see 50:1, you see 100:1, is just like that. So, but before we move forward, let me explain this thing to you. Very, very important. Now, you see, maybe you are already thinking that, oh, you want to look out for a broker that will offer you, because there are brokers like XNext actually offers, I think, up to like 2,000 to 2,000:1. So it means that it simply means that for every $100 account, you can be able to trade up to $2 million worth of orders or orders in the financial market, in trading, in forex trading market. All right. So all right, so yeah, I was explaining something. Now I know some of you might be thinking of, okay, how to like outsmart the market or outsmart your broker, or you are looking out for a broker that offers the best this thing. But now this leverage is a double-edged sword. All right. Now, for instance, let's use let's use the same example that was used here. That's 50:1. So we are using 50:1. This very one. We're using 50:1. And in 50:1, we're using 50:1. So it means that, so you trade. Now, you see, what your broker does actually is that you'll be thinking that, yes, they are borrowing you money. The money they are borrowing you is just to enable you to, enter the financial market, like to actually enter the, forex trading market. Okay. So it's not that. Okay, now ask yourself, what if you lose the trade? In the trade, maybe you enter a buy trade and then the trade starts going against you. It's going long. You are actually looking for like a, you are looking for a going long trade. And what you are seeing is shorting. Right. All right. So does it mean that they are losing their money? Because now, in this case, now they are borrowing you money. It means that on a single dollar, they are borrowing you $49 added to that your $1 to make it $50. So what if you now lose that money? So what happens to them? See, what happens to them is that when you place an order, for instance, maybe you place a buy order, what your broker do actually is that they firstly push that your $1 forward. So if you loses that your $1, or if you lose your $2 or your $3, they will take you out of the market. Like they will take you out of the market. Like you will not be able to go forward. Like you will not be able to go further for that particular trade. You understand? So that is simply what it means. That is simply what it means. So they borrow you money, like quite alright, but they can't lose the money. Okay, so they are sending the money they are borrowing you is just to enable you to trade that market, trade in that market, to be able to place that order, because they know that you don't have like up to the amount that is required to trade the minimum lot size, which is micro lot size. All right, so you've already understood that. Okay, so the next terminology I would like us to look at is bid price, ask price, and spread. All right. So now understanding the term bid, ask price, and spread is essential for every investor, or for any investor looking to trade in the forex market. They refers to the price of currencies when buying and selling, as well as the difference between those two prices. Now, very quickly, let me explain this in a way that I think it should be the best way to explain it to you. All right. Have you noticed that when you enter a bank, like your bank, maybe you went to deposit money, you went to withdraw, maybe you just go there to make a complaint or something? Have you noticed that like something like there's a board that is usually placed on the wall, usually like in the reception, at the reception, they usually place like on the wall, they put "we buy art." You see, we sell art. So they will now put the figures, write the figures down. They put the figures down. Some of them. So it means that when you are buying dollar from them, they sell it. They are not selling it like when you are buying from them, and then when you are selling, they are not giving you at the same price. For instance, okay, I think, okay, all right, yeah, I'm still on the track. All right, so the best way to explain it is that now you go to bank, and then your bank now is telling you that, okay, if you want to buy dollar from us, this is the amount. If you want to sell dollar to us, this is the amount that we pay you, that we are buying from you. But if you want to buy from us, this is the amount that we are selling. That is the first example. Now, let's say maybe somebody just dash you dollar now. Somebody dash you $100, and then maybe you just go to any of these bureau de change guys, and then you want to sell the dollar. So if you are selling now, if you sell the dollar for them, if they buy $100 from you, let's say 1,050 naira, for instance, 1,050 naira, or 1,050 naira. If they buy from you 1,050 naira, after immediately you buy it, ask the guy back and tell him that you want to, buy it back from him, that he should sell that same $100 to you. Even though the exchange rate is still the same thing, but it will tell you that, okay, if you want to buy is 1055 naira. So it means that now the bid price it is the amount that the buyer is willing to pay, or the maximum amount that the buyer is willing to pay for a commodity or in the forex market. All right. Now the ask price is the price that a seller is asking a buyer to pay, the maximum amount that a seller is willing to sell a commodity or sell a maybe a product to you. All right. So that is the bid price, and that's the ask price. And the difference between bid price and ask price is spread. All right, is spread. So and that is one of the primary way that your broker earns their profit. Okay, that's the primary way that and the spread. I'm talking of the spread. That's the primary way that your broker earns their own profit. When you deposit money into your trading account, the account you open with your broker, they will not charge you. They will not give you maybe charges or commission or something. They are not doing anything like that. But on their own, when you are selling, when you deposit money, for instance, maybe you want to deposit $100, it might cost you let's say it costs you 100,000 naira. All right. Now, if you want to withdraw that same $100 into your Naira bank account, to your Nigeria bank account, it might give you something like Naira 95 naira. All right. It might give you as Naira 95 naira. So that little spread, that little difference is their own profit. All right. So that's their own profit. So okay, now let's check these two pictures here. This very first one, let me shift this one here. Okay. All right, let me shift my camera here. So this very first one is already telling you now. You see the bid, bid equals to selling price or sell price. It's pointing there. Now ask is buy price, is pointing there. Now you see the bid price and the ask price. You see that there's a little difference there, and which is about, okay, I don't know which currency they are using as example here anyways, but you can see now. You see this 80, you see this this 80, and then you see 30. So it means that the difference, the spread now is not the 50, the in between 50. All right, the spread is the in between 50 between them. All right. And if you want to use the second this thing here, let me zoom out so you can see very well. All right, now let me use this one. I think this one is very okay for the explanation. All right, now the base currency is euro. The quote currency or counter currency is dollar. All right, US dollar. Now, unlike our class yesterday, what we have in class yesterday, Euro USD, you just see that it was only one price that is there. But now you have seen two prices. One of the price is a bid price. The other one is the ask price. Now, the difference between the bid price and the ask price is now the spread. So in this case, it is calculated in pips. In this case, it's calculated in pips. All right. So, and if you check under, you see spread is equals to 1.1053 minus 1.1052, which is 2 pips. So 2 pips is now the spread. 2 pips is is the spread, is the profit for the broker. I would like to do something, but I'm not having my any of my MetaTrader application on this particular phone. But we just do I think I will still do another video. It's very important. I will still do another video to show you how it is, how it appears on your trading chart. All right, how it appears on your trading chart. So do you understand very well? If you don't understand, you can still backward the video. Just backward the video and listen to it again, or watch the video from the beginning. So so you already know the bid price. The bid price is the price that you as a seller you want to pay. You are going to pay, right? Sorry, you are the buyer that you are going to pay. That is the amount you are bidding, all right? So, and then the ask price is the price that the seller is, asking you to pay. And the difference is the spread. So it's as simple as that. All right, stop loss and take profit. Very important. You see, we're already getting close to our trading chart. All right. So stop loss and take profit. Both stop loss and take profits orders are basically what's this thing saying? All right, okay, let me go back again. Both stop loss and take profits orders are basically you as a trader telling your broker when to close your trade. All right. A stop loss is designed to let your broker know how much you are willing to risk with your trade. A take profit is pretty much the exact opposite. So let me use this picture below to explain very, very well so you will understand. All right. Now, let's say this is a price movement. Let me bring my camera here. Like this, a price movement, and the market has been moving like this, coming back, and then moving up again. All right. So now, let's say you are done with your analysis. You've analyzed very well, and then you realize that I think, based on my analysis, this price will still be. Let's assume this. Let's assume this is Euro, EUR, USD. Let's assume this chart is for Euro USD. All right. So it means that you are predicting that, you've done your analysis, you've done everything clear, and then you are now predicting that based on my analysis, I'm clear, and then I'm very sure that I'm predicting that Euro will be increasing in strength. That is buying. In this order now, it means that you want to place a buy order based on your analysis, all right, for instance. And placing a buy order means that Euro will be increasing in strength while dollar will be reducing in strength. In another way, it means that you want to buy Euro and sell dollar. Remember, Forex trading is, buying one currency and simultaneously selling another. Okay. So if you are buying it, if you place a buy order, it means that you are buying Euro and selling USD. If you click a sell order, it means that you are buying USD and selling Euro on still the same chart. All right. But in this case, you are done with your analysis, and then you have spot possibility that Euro will be increasing in value. You now place it. Now, so what take profit means is that if price goes in your direction, it came up here, came back down, went up again. So it means that you are predicting that it will still be going up. All right. Now, this take profit that you are seeing here, it means that when the price eventually gets to this level, because this is the current level of price. This is let me use this green. This is the current level of price. That's where you see entry. All right. That's why you see entry there. Okay, let me clear everything again. So it means that you are placing order that this price will still be going up. That's why you see this arrow going up. And then it means that when the price eventually gets to this level, you are okay with the profit. That is what it means by take profit. So it means that when the price reach there, you should already be in profit. All right. So now you are giving your broker order that when the price gets to this level, take me out of the market. I'm okay with the profit. And it is very important when you set a take profit, you also set a stop loss. All right. So because Price can only move in two directions. Yes, okay. Price can move in three directions, but like commonly in two directions. The first direction is going up, like we see. The second direction is coming back down. All right, let me come back to my. I don't like this long gone. All right, let me come back to my arrow. The second direction is like coming down. Now, the third direction, I think I can now use this one. Let me use yellow paint here. The third direction is that the market is just. Oh no, this is the arrow. This is the arrow. All right, let me just clear everything. So the third direction means that the market will be moving sideways, ranging. All right. So that's the three direction that price can move. So this one is called indices, like ranging market. All right, ranging market. Okay, so that is it. So now, so you already know what stop loss means. So it means that, so if your analysis fails, so it means that if the price is coming back against you, once it reach this level, your broker should take you out of the market with the loss. So it means that you don't want to lose more than this amount, the amount that you like must have lost here. You don't want to lose more than that amount. So that is what stop loss is. So I think that's very, very clear now. All right, so let me bring back my camera. So that's stop loss and take profit. Don't worry, by the time we start our practical class, you will see all these things into life in life. All right, so we have come to the end of, now not today's class, but to the end of this particular topic. So very, very quickly, let's just touch the next topic, which is FXT103. That's trading chart and types. That's the types of trading chart. Okay. All right, but please, before we go ahead, I would like us to do something. Please, if you're watching this video, you're watching like this very lecture, and then you have not subscribed to our YouTube channel yet, please go ahead and smash the subscribe button, okay? And also, if you are understanding the class, please just go and comment in the class, and just use the, like, go to the comment section and just drop your comment that I understand, I'm enjoying the class, I understand everything, okay? And like, probably if you have any question, you can drop it there and ask too. All right, so yes, let's move ahead. Wait to are you sure you okay? Smash the like button. Yes, make sure you smash the like button and smash the subscription button. All right, so okay, very quickly, let's move ahead. So the subtopics in this topic is we have forex charts, we have type of chart, and candlesticks. So the reason why I pick only candlestick is part of like type of chart, forex chart. All right, but candlestick is the most commonly used one. All right, so, and I will tell you the reason why it's the most commonly used one. All right, so before we move ahead, if I could use this. All right, now forex trading chart. A forex chart graphically depicts the historical behavior across varying time frames of the relative price movement between currency pairs. Technical analysts and day traders will look at such charts in order to identify trends and various patterns that can signal reversal, continuation, entry point, and exit. All right. So I know you have seen trading chart before. So like it is now. So trading chart is that a graphic sorry, excuse me. So a forex trading chart graphically depicts the historical behavior of price. All right. So with a trading chart, you can know like the movement and the like the action, the movement of price. Let's say we'll still be using Euro USD for instance. We'll still be using Euro USD just for illustration purpose. All right. So excuse me. So now it means that so on trading charts you'll be able to know how price has moved in the in the previous time. Okay. So now technical analysts use trading charts to try to make their analysis so they can make a better prediction of where price would be going, if it would be rising or falling. All right. So now very quickly let's check types of Forex chart. All right. So let me zoom this one here like this. All right. The first one is line chart. Okay. The first one is line chart, and we can clearly see how it is just moving almost like zigzag line and all of that. So now you check here, you see let me bring my camera here. Okay, I need my candle here. All right, so here you see September, October, November, December, 2018. That's January, February, and March. All right, so it's giving you the movement of price over like some months now. Okay, for some months now. All right, so that is what it does. So this is how line chart is. This is line chart. All right, so the next one is bar chart. All right, so this is a bar chart. You can see that it is still the same movement. It is still the same movement. We are not using the same. This is this particular chart. This line chart is for a different currency pair or for a different asset. Okay, but this bar chart is also for a different asset. All right, so that's the reason why that you are not seeing it in the same way. You see this one now is almost moving up. You see, it is uptrend. So it's moving up. You understand? But this one is sideways. This one is ranging. All right, you can say it's ranging, you can say it's moving sideways. There's no really serious decision. It's just moving going up and down and all of that. So this is bar chart, and this is how it looks like now. So now to our very popular candlestick charts. You must have seen this, I believe that. So to our very popular candlestick chart. So this is how it looks like. So we'll be going straight to candlesticks chart now. All right, and why do they call it candlesticks? So you see everything now. So a candlestick chart. A candlestick is a way of displaying information about an asset's price movement. All right, candlestick charts are one of the most popular components of technical analysis. Is very, very important for technical analysts. All right, so it enables traders to interpret price information quickly from just a few price bars. All right, and candlestick is used in technical analysis that displays the high, low, open, and closing price of a security for a period of time. It comprises the body, the wick, and color. All right. Now, you've been seeing candlestick, you've been seeing candlestick. So this picture explains it very, 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 very better. All right. I don't know. Let me just shift it to this side like this so my camera will not be blocking it. All right. So, you see this now? Now, you see, let me bring my camera up here because I need my. All right, you see, this is a green candle. This one is a green candle. Let me use a green distance for it. All right, sorry, come back. Okay, clear everything. All right, so now this is a green candle. Now, you see this green candle, it is like the candle that prints when price is increasing. All right. It is also called bullish candle. All right. And you see the bullish is yeah. Now this green candle is called bullish candle and is increasing candle, whereas this red candle is decreasing candle. That is when the price of an asset is decreasing. So it means that when you place an order to sell Euro USD, it means that you want to be seeing red candles like this. So if you place a buying order for Euro USD, meaning that you want to, you want to buy Euro and sell dollar simultaneously, it means that you want to be seeing this green candle, because this green candle is the increasing candle, is the candle that like print when the price is increasing. You understand? So that is it. Now the reason why they call it bullish and bearish is just like the a market, maybe nickname for it, or just a market name. All right. So and then the bullish and the bearish is picked from these two animals name: buffalo, bull, and bear. All right. So like this our logo, for instance. Let me just quickly, all right, let me close this one for instance. Okay, now see, this is our logo. This is bear. This red one is bear, that is, and which is red. I told you which is red. This is it. All right, and the green is the bull, buffalo. All right, so that is it. So that's the two animals. So some forex trading logos or something, you see things like this and all of that. So from the explanation above, it was mentioned that it comprises the body, the wick, and the color. All right. So for a bullish candle now, let me come back to my arrow key, arrow tool. For a bullish candle, from here, now this place to this place, like you see it, is the body. All right. Now you see this tiny black line is the wick. This one is also the wick. All right. So let me bring another one again. All right. Now, for a very bullish candle, this is where price open. This is the opening level of the price. This is the opening level of the price. And this is the closing level of the price. The reason why you are seeing this wick is that I think I will explain it better. Okay, but let me just explain it a little bit. The reason why you are seeing this wick is that you see high. You see high here, and you see low here. All right. So what it means is that now you see. Let me come back to this. Let me see if I will see this thing here. Can I see this? Oh, it's not coming out. It's not visible now. But what I want you to know is that in your trading chart, you can set the time frame to minute. You can set it to like 1 minute, 5 minutes. It's 1 minute, 5 minutes, 15 minutes, 30 minutes, 1 hour, 4 hours, 1 day, 1 week, 1 month, like that. So if you set your trading chart to 5 minutes time frame, it means that each of the candles represents 5 minutes. So each candles, like this one, the one you are seeing here, like each of these candles, each of them form for 5 minutes, 5 minutes each. If your time frame is 1 minute, so it means that each of the candles forms for 1 minute. If it is 4 hours, it means that each of them forms for 1 hour. So now it means that this particular red candle, this particular one, it means that if your trading chart is like set to 4 hours time frame, it means that this candle, it took 4 hours for it to finish printing before moving to the next one, this next one. You understand? So it takes another 4 hours. Sorry, I say if you set it to 4 hours, right? 4 hours time frame. It means that, so this next one, let me close this one for now. So this next one as well, it takes another 4 hours for it to print. So now, if you are using 4 hours, so it means that within let me say within 12 p.m. to 4 p.m. that is what it takes this candle to finish forming before starts forming this very one. All right, so now let me come back to explain this. All right, so it means that we are still using that same 4 hours. So it means that within that 4 hours, when that 4 hours started, that 12 p.m., this level was where this was the level of the price at exactly 12 a.m. dot. Sorry, 12 p.m. dot. You know, we are using 4 hours candle and we are starting from 12 p.m. to 4 p.m. All right. So this is where it starts. Now, so is that now if the price come below, it means that within these 4 hours, let me close this. It means that within these 4 hours, price has come below. You understand? Price came below. Price came below. And this low that you are seeing, that was the lowest level that the price came, because the price actually fluctuates. All right? The price actually fluctuates. So this was the last level, the lowest level that the price, reached within that 4 hours. And this was the highest level it's reached within that 4 hours. You understand? And this was the close level. It means that this was the level that, like, the price was. This was the price level when at the end of the 4 hours. This is the end of it. Like, this is 4 p.m. dot. All right? So if it is 1 minute time frame, it's the same explanation. If it is 5 minutes, it's the same thing. So that is the reason why. Okay, let me just quickly explain. The bearish candle. That's the decreasing candle. So the negative, the opposite is the exact opposite is the case here. All right. Now, this is a decreasing candle, right? This is a decreasing candle. This is a decreasing chart. This is a decreasing candle. So it means that, let's check, try to bring out this thing again. All right. So we are still using that same 4 hours. So it means that, let me close this one. How this thing will still be here. All right. So it means that within the 4 hours, so at 12 p.m. dot, that was when this candle, this very red candle, start forming. This very one. All right. That's when it start forming. Okay. Let me clear it. So that's when it started forming. All right. So, and this was the opening level. So opening level. This is the closing level. And this is the low. This is the high. The low and the high remains. All right. So what it means is that the price opened here at this level. The price opened here. And then this was the highest level that the price went within that 4 hours. All right. Now, this was the lowest level that the price, moves. I told you it fluctuates, right? Don't worry. When you see a live chart, you see how it works. And this was the closing. So what makes this candle red actually is that it closes below the opening level. It closes below the opening level. You understand? Now, what makes this one, and that's what makes it bearish candle. That's what makes it bear. Now, one thing you should know is that, okay, let me just ask a question. Assuming we are still in the middle of the 4 hours, right? Let's say maybe the candle started printing 12 p.m. as we, as it was mentioned earlier. And then maybe it was maybe we are currently at 2:35 p.m. But that 2:35 p.m., let me close this one and reopen it again. So, but that 2:35 p.m., at 12 p.m. dot, price already open here. So 235 price was around here. So the candle was still forming, was still forming. And let's say, now let me ask you a question. Let's say the price now eventually close around here. What will be the candle? It will be bullish candle. It will be green candle. It will be this one. It will no longer be red. It will now be green. All right. So the rule is that the thing is that, like, if price closes below the entry level, in this case of this bearish candle, it will be red. It will be bearish. It will be a bearish candle because it's decreasing. Now, if it closes above the entry level, in this case of bullish candle, this one, it means that that's this one. It means that is increasing. All right. So I think that's explained very well. If you don't understand, you can backward the video and watch again. All right. So you can just check again. So, and then with that, we've come to the end of the class for today. All right. So tomorrow, by the grace of God, we will be treating the last course or topic in this course, and that is when we'll be making use of, like, we'll be going practical very well, because you want to understand how what are the moving averages, and then we make it both theory and practical. All right. So, and we'll be touching a little part of technical analysis. That's why I put technical analysis 1. So that is it. All right. So we have come to the end of the class. Thank you very much. Thank you for being patient with us. We'll staying to the end of the class. Yeah, thank you very much. You are the best. All right. You are the best. Please, if you've not dropped your comments on this video, please go to the the comment section and drop your comments. If you understood everything that you were taught tonight, drop it there. That yes, very, very understood. All right. So, and if you have any question, is that you can drop it in the comment section. It will be attended to, or come to our WhatsApp class to attend to that. Now, I noticed that some of us, our yesterday lecture, I dropped some questions there, but some of us just decided to refuse, decide to not to attend to the questions. A few of us attended to it, and we did very, very great. It was the last question that majority of us picked the wrong answer. But it's very fine. That's it is a joy for me, because I'm very happy. It shows that you are following up. It shows that you listen to it. So tomorrow is the last class, and we'll be looking at how to we'll be looking at FXT104. That's moving averages and indicators. All right. So thank you very much for staying to the end of the class again. I'm still your instructor or your educator, Forex educator for this class, this course. My name is Yisra'el King. All right. Thank you very much. See you in class tomorrow. Thank you.